Mark Selby, how are we, sir?
I am very, very good.
Glad to hear it. Raining here, sunny there.
Yes, the world
Things are
makes
on.
sense, at least
Make,
in one dimension.
maybe not quite share prices, although I do see some green shoots appearing in sort of battery metal stocks of up a few percentage points. So maybe there's blue skies on the horizon for everyone. Let's kick off and try and understand what's happening in the world of nickel at the moment. Let's start with maybe price, if you don't mind.
Sure. Yeah, no, another sideways week in the world of nickel prices, basically either side of $21,000 a ton. LME inventories remain low. So, there's been a few bearish bumps from here and there come out, but the bears don't seem to have much courage without a lot of inventory sitting there and again, despite talk of large surpluses, very little of this inventory, seems to be showing up on the LME. And again, in China, the surge we saw in June in the battery sector is kind of eased off a little bit. It didn't follow through in July, August, but surprisingly, NPI prices picked up a little bit. Which again, all through this year, I've been saying, look, we need to break $20,000 a ton here at some point, and yet we still haven't done it. And again, I would not have expected to really see NPI prices start to move higher at all until sulfate tightened up and LME prices start to move higher from here. So it's good to see. And again, I mean, to me, that makes me skeptical that there's lots of inventory around if for somehow the price of that inventory is moving higher. There's a little bit of a disconnect there.
Well, okay, let's talk about that, because I think last week we talked a little bit around sort of nickel refining capacity. LME just made an announcement, or at least approved some nickel produced out of China with the kind of new fast track registration system for Zhejiang, Huayou. I'm going to go with. Let's say that's about right. What can you tell us about that?
Yeah. So. There's not a pile of news this week, but this was a key piece of news. Obviously, about 15 months ago, the LME broke. One of the key pieces in terms of getting the LME back to a more functioning market was they were going to be a lot more aggressive about approving new brands. They used to have quite a long period of time before you could deliver physical metal against contract. And again, that's the whole part with the LME, is that in any contract, if you show up with a piece of paper, there used to be pieces of paper to an LME warehouse somewhere in the world, they would be responsible for getting you 6 tons of nickel at that point in time. So having physical metal to be able to actually settle trades is key here. So and this also is another key part of something I've been talking about all year long in terms of this great convergence, that because a lot of material was not LME deliverable, that the discounts for NPI and MAT became the market clearing mechanism as opposed to the LME price, the commodity price, which is typically what happens. And so one of the key pieces of that was you're going to start to see refining capacity come online that will allow consumers to actually have more options to refine nickel and then deliver that nickel onto the LME. So Zhejiang Huayou basically has got their refinery up and going. They were able to get, they're the first of the new refineries. There's a couple others in the pipeline that were able to get it as a registered deliverable brand. So again, very intrigued to see whether, quote, how much of this surplus that we've experienced in the last 4 to 5 months, makes its way onto the LME. Because if it's really there, then, this is the path, that should make that just about as visible as possible. So, in terms of scale, I mean, again, this is not massive. We're not talking about 10 or 20% of global capacity, but, there should be about 200,000 tons of capacity come online by the end of next year. And again, given China usually comes on a little bit faster in terms of processing capacity. And we should see about 100,000 tons of nickel, or about 3% of the global market, actually be produced by these new refineries. And again, that's significant in the sense that, the kind of surplus that people are talking about are in the range of 100 to 200,000 tons this year. So theoretically, that should allow all of that inventory to make its way, to the LME if it's sitting out there. So, and again, the big thing is at the end of this great convergence, we'll get to the point where discounts get back to normal levels. LME prices, we probably will be lower than they otherwise would be. But again, they'll be back to a market that makes sense and allow pricing of all the intermediates in the business to be a lot more effective.
Right. Okay. So market that makes sense is critical here, because you can work out where you're going with that. And there's been such a lot of irregular pricing in the market of recent time. Let's just talk about China a little bit. So obviously, well, are you at all concerned about some of the numbers that have been coming out of China for the last 3 weeks in terms of maybe a slowdown in their economy and maybe this kind of knock-on effect here, or just the supply-demand fundamentals of nickel, copper, and the rest of the EV metals really negate all of that?
Yeah, no, I mean, obviously, a slowdown in China does have an impact because, for nickel, it has, batteries, obviously a big source of new demand, but the bulk of demand comes from, would say more traditional uses going forward. That being said, I think there's a few offsetting factors that, is allowing me not to lose any sleep over that slowdown. Number one, with Indonesia industrializing now with again, driven by the whole nickel stainless industry, you've got a whole, close to 1 billion people in Southeast Asia that are, on that development track as well. India seems to be, again, starting down that track. And so those are two big sources of new sources of stainless steel demand that I think people discount in terms of its impact on global markets. The other piece is there's been two massive headwinds for nickel use. There's a chunky sector of nickel demand that it makes alloys for the oil and gas industry and alloys for the aerospace industry. And, coming into COVID and through COVID, obviously aerospace, was not a big winner. And then as well on the oil and gas sector initially until the war in Russia came along, oil and gas was in the doldrums. And so now both of those industries have seen some revitalization. So those are big new uses, not new uses, sources, big new sources of demand that should help offset any weakness that we see in China. And then obviously the EV story, China is not the market for nickel batteries because they don't drive massive cars and they don't drive long distances. It's really about EV demand now in North America and in luxury vehicles in the Western world. And so, that continues, I think, at a pretty healthy clip. And so again, from my view, the long-term nickel demand, the current demand picture, should improve as we go through the rest of the year.
Right, and again, as we've talked about on multiple occasions over the past few weeks and months, M&A activity continues to kind of, well, it's not taking a rest anytime soon. Companies are trying to find the next big thing. Numbers, as perhaps as you've been projecting all of this year, looking like they do. Do you still expect to see more M&A? Do you expect to see more money flowing into the nickel market? And where's that coming from? Where's the money actually going to come from for this? Because it feels like we've reached saturation point in terms of the mid caps and majors in terms of their appetite. Is there going to be new money coming into the space?
Oh, for sure. I think, the key here is the majors are still, in terms of when you look at their core businesses of iron ore and coal, they're generating massive amount of free cash flow. They've all indicated a desire to reposition themselves, into the battery sector. We've seen a bunch of deals from BHP and Huayou. But in reality, as much as we've seen a lot of deals, they're barely scratching the surface in terms of moving the needle for their entire company in terms of the amount of resources they've got to date. So, there's a long room for a lot more M&A to come from the major and mid-tier mining companies as we move through the battery cycle. And again, if we do not see any improvement in equity values before the end of this year, I think, once it looks like interest rates have topped out, we're probably going to be on a weakening cycle for interest rates as inflation comes off. I think that'll give the majors the courage to step in and do even more transactions by year end. So I'm pretty bullish by year end and into next year.
Right. Okay. And talking of that, obviously one of the companies which has been out there, I think we've been big fans from day one, is what Poseidon Nickel has been doing over in Australia. They've got a little bit of news out in the market at the moment. What can you tell us?
Yeah, pretty surprising actually. So they were on track for restarting their silver. They have two deposits. Well, they have two sets of deposits. They have the Black Swan, Silver Swan complex, and they have the Emily Ann Maggie Hayes complex, both of which are past producing mines in Australia. we talked last week about some exploration results from Emily Ann and Maggie Hayes, which were intriguing. The unfortunate part is they basically reset their timelines for when they're going to restart restart Black Swan and Silver Swan at the same time. So Silver Swan is a super high grade. It's one of the highest grade mines that's ever operated in the nickel industry. Black Swan was a larger scale disseminated ore body that sat next to it. There's a brand new mill that only ran about 18 months, 2 years back in the late 2000s, and unfortunately got squeezed in the nickel market. But I think the announcements, they basically talked about that one, they're not going to get grid power until the end of 2024. Obviously that's usually a lot cheaper than running your own diesel generators. Disappointingly, they said they're going to have to do additional metallurgical test work to confirm the recovery assumptions for what they are planning to process as part of the mine plan. And more broadly, delaying things because of these project factors and market factors. The other thing they highlighted in the quote from the CEO was, tightness in the Western Australia labor market and, the inability to actually house fly-in, fly-out workers, in the Kalgoorlie region. We've talked a lot about different factors. Again, so many investors focus on grade. None of what's happened here has anything to do with grade. These are all the other factors that are as important that investors never spend enough time on. And so let me just sort of walk through some of the key bits here. One, in terms of availability of infrastructure, again, building a mine when you've got the roads, the highways, the power line and power that can come in on those power lines, is a massive, massive advantage. They basically said, and they're not in a particularly remote location with Black Swan, Silver Swan, but they're not going to be able to access that grid power until the end of 2024. So nearly 18 months from now, right? Again, if you have long lead items like that, that's the kind of stuff that maybe you should have started a little bit earlier on. But again, it's always tough when you're trying to restart an operation. The other big thing, one of the big pluses that we have at Crawford, we're sitting just outside Timmins. We've got 3 decent sized towns that are all less than an hour's drive. People can, there's not enough houses right now, but we can, people will build those houses and they will live there, when the time comes. And so the thing about West Australia that I don't think people recognize, it is one massive fly-in, fly-out operation. If you go to the Perth airport early in the morning, you will see almost 2/3 of the people in the airport in high-vis suits flying off to mines, all through Western Australia. And so the problem with that is if you got to show up to an airport and get on a plane, whether that plane travels an hour and a half or 2.5 hours, really doesn't matter. And so, what that does is that labor will change, in a heartbeat. And so you have to pay up. You have to, treat them properly once they get to camp, and again, they're all competing for the perks at each camp. And so it just makes it very, very expensive and not particularly productive all the time, if you're trying to compete for that marginal fly-in, fly-out worker. So again, in places where you can have a domestic workforce that drives home every night, it's a massive, massive advantage. So that's number 2. Number 3, we've talked about in the nickel grades. Again, people point to, it's, Crawford and some of our other targets are low grade. Yes, it's a low mining grade, but in the nickel space, the ability to make a high grade concentrate is extremely, extremely valuable. A lot of high grade nickel mines start at 3 or 4% and struggle to get to a 12 to 15% nickel concentrate grade. In our case, we're able to produce a 30% plus nickel concentrate just to the nature of the minerals. Unfortunately, because of the nature of the minerals in these deposits, and they highlighted the fact that more than half of their ore is contained within this talc carbonated ore, and talc floats along with the nickel minerals that you're trying to recover. At best, they're able to, from a big chunk of their feed, only produce a 5 to 6% nickel concentrate. The ability to ship that any distance makes it pretty expensive. The ability to process it, because you've got 95%, of waste material that you're trying to get rid of, makes it a pretty expensive proposition. So again, with deposits like Crawford, we can get to 30% plus. you know, it's a big opportunity. And the last piece, one of the things I've been, proudest of is, we've gone from the 5th drill hole to a feasibility study coming in September in 4 years. That I think is probably less than half the time that you would see most companies get through that process. All the way along, we've been parallel processing in terms of defining the resource, defining the mine, doing the mineralogy work, doing the metallurgy work, so that when we get to the end, we're not going to expect any real surprises. And so it's a little disappointing that they really didn't identify the mineral, because again, the kind of challenges they're talking about are well known with these kinds of deposits, and you would think that you would have done extra work early to make sure that you weren't going to run into those kinds of problems before you put the feasibility study out. So the good thing is they didn't charge down the path and sort of find out about it or think, oh, geez, maybe we can fix this by the time we get the mine going, because that does sometimes happen, sadly, in this industry. But they're having to take a step back, and they haven't even committed to when they're going to actually go ahead with the project now. So that's pretty disappointing, and not surprisingly, the stock sold off pretty hard off the back of that news last week.
Okay, so it's kind of interesting. We've talked about there's the cliche. I think it's a cliche for every single argument you want to make in mining, but grade is king, right? So grade is definitely very, very useful. High grade is very, very useful. But as I think you've just articulated quite nicely, there's a whole bunch of other variables which also matter, because it's about operational margin that these different determine whether these things will work or won't work. And I guess the thing to do is try and identify those economics well before you start allocating the capex or the opex to these projects. So sort of looking around at the moment, obviously there's a few companies that are perhaps experiencing those sorts of learnings, much to the, I guess, chagrin of the investing community at the moment.
Oh, there was, and this morning another great example. So South 32, one of the larger of the mid tiers, or smallest of the bigger, I guess the largest of the mid tiers. Again, they splashed out for the Hermosa buying Arizona mining back about 5 years ago with one of the best high grade lead, zinc, silver deposits that had come along in quite a period of time. And they had bought it for $1.3 billion, and they announced a $1.3 billion write-off today. But given some of the other work that they've done, it still has a carrying value of $1 billion. So it wasn't a total write-down. But again, one of the key things they're pointing to is they have to spend an additional $350 million US in being able to dewater and treat the water that comes from the dewatering in order to be able to mine that deposit. Again, it's kind of weird that you'd think you have to worry about dewatering the deposit in the desert. But again, I was with Quadra Mining a few years ago, and I know our Robinson deposit in Nevada in a desert also had some significant dewatering issues that we had to manage whenever we looked at expanding that plant. So again, they should not have been surprised that could have been an issue. And those are the kind of things you'd like to flag. You think you flag as best you can in a due diligence process. But again, it just underscores the fact that, grade is just one more variable.
It really is. And I think we've talked about that long and hard in the past, and I'm sure we'll have to in the future, because no matter how many times we say it, people don't kind of get it. But those are two quite good examples where perhaps I could prove the case somewhat. Mark, okay, so I think that is it for this week. And it's a quiet week. I think people are sort of maybe nestling into their summer holidays now and looking forward to September when the conferences start anew. People are starting, it seems to be a lot of roadshows organized. And we'll sort of see how the market reacts. How are you feeling about the Fed? Any future interest rate rises, etc.?
No, I think I think the inflation data is finally starting to cool off. Again, they will want to make sure, given that how much of this was the first time that we saw a pickup inflation that really translated into increased labor costs. And that's fundamentally, that's how inflation cycles get entrenched. And so, again, I think they'll err on the pushing it a little further than they otherwise would to kind of beat out those inflation expectations that have crept in to people's minds. But I think we're pretty close to the top now, and we should start to see things loosen off in the next while, as long as we don't see anything crazy coming out of Russia in terms of energy supply or out of OPEC. But fingers crossed. I think the worst of it is here behind us in terms of interest rate rises, and again, I think that sets the stage for a better market towards the end of this year, as people get comfortable that the worst of recession fears have gone, and now I can start to think about positioning myself long again in the market. So